Welcome to Inside the Economist's Mind today. We're diving into Australia's Q1 2025 GDP preview, where private sector strength is helping offset slowing household consumption, and all eyes are on the Reserve Bank as inflation nears its target. Okay, let's set the stage for this deep dive, shall we? We're ripping into some of the very latest economic intelligence, specifically a sneak peek, a preview, if you will, looking ahead to Australia's official gross domestic product figures for the first quarter of 2025.
hmm
This isn't the final official government number yet, but it's a highly informed analysis predicting what those numbers are likely to show.
That's right.
And our guide for this journey today, our source material, is a detailed report put together by the sharp minds over at NAB Economics.
Yep, the NAB team.
The document itself is hot off the press, dated May 30th, 2025, which means we're getting a really timely snapshot of what leading economists were anticipating just days before the official data hit the streets.
And the mission for this deep dive is crystal clear. We're here to act as your guides through this specific piece of analysis. We're going to meticulously break down NAB's forecast for Q1 GDP growth, dissecting it piece by piece.
Really get into the weeds.
Exactly. We want to help you understand exactly what this particular set of data points and analysis is telling us about the fundamental drivers steering the Australian economy right now. And crucially, we'll explore what the implications of this forecast are for the Reserve Bank of Australia, the RBA. They're currently in a really interesting phase, navigating their twin goals of managing inflation and supporting employment.
Tricky balancing act.
Definitely. So it's about drilling down into this specific source, grasping its nuances, and pulling out the absolute key insights that truly inform our understanding of the economic landscape right now.
Exactly. And remember, everything we discuss in this deep dive is drawn directly from this specific NAB Economics preview document.
Just this source.
This deep dive is custom built for you, the listener, to give you a super efficient, clear, and insightful picture of Australia's economic pulse, according to this timely source material.
Yeah, giving you the main takeaways.
We're giving you the shortcut to being well-informed on this exact topic, allowing you to quickly grasp the core story and key nuances without having to pore over the report yourself.
Let's really dive in.
Okay, let's properly unpack this.
Yeah.
When you crack open this NAB Economics preview, what's the absolute headline number? What are they forecasting for Australia's overall economic growth in the first quarter of 2025?
Okay. Based on the detailed partial data they had available up to May 30th, NAB's headline forecast for Australia's GDP growth in Q1 2025 is 0.5% compared to the previous quarter.
Right.
That's a quarter-on-quarter, or QQ figure.
All right, so 0.5% growth in 3 months. How does that translate when you look at it over a full year? 'Cause sometimes the year-on-year figure gives a different perspective, ironing out some quarterly volatility.
Yeah, good point. That 0.5% quarter-on-quarter growth is projected to translate into a 1.7% growth rate when you compare Q1 2025 to the same quarter a year earlier, Q1 2024.
Okay.
That's the year-on-year YA figure.
Okay, so 0.5% in the quarter, 1.7% for the year. Now, what's fascinating here, and the source points this out up front, is how this specific prediction lines up with the RBA's own view. Does NAB's forecast surprise the RBA, or is it pretty much what they were expecting?
Yeah, this is a really important point the report makes. It explicitly states that this expected outcome, the 0.5% QQ and 1.7% water growth, is described as being broadly in line with the RBA's Q1 forecast in the May SOMP, Statement on Monetary Policy. That's where the RBA lays out its economic outlook and forecasts.
Right. Why does that alignment matter so much? Why is it significant that a major commercial bank's forecast is broadly the same as the central bank's own forecast for the same period?
Well, it's significant because it suggests that, based on the economic data that had become available up to late May, the Australian economy appears to have been tracking largely along the path that the Reserve Bank itself had anticipated for the first quarter. For the RBA, this is a form of confirmation. It means the actual official GDP data, when it's eventually released, isn't expected to contain any major surprises regarding the headline growth rate.
No big shock.
That would force them to fundamentally rethink their immediate economic outlook for that specific period, at least not based solely on this growth number itself. It confirms their baseline expectation for Q1 was reasonably accurate, according to this preview.
Got it. So it's like a status check confirming the RBA's map of the economy for Q1 was pointing in the right general direction for growth. But hold on, the official GDP numbers aren't even out yet when this preview is written.
Right.
How can NAB economists arrive at such a specific prediction before the final numbers are calculated and released? What magic are they using?
No magic, thankfully. It's based on rigorous economic analysis using what's called partial data to date.
Partial data.
Yeah, think of the final GDP number as a massive, complex jigsaw puzzle. While the final complete picture, the official GDP release, isn't available until a specific date, many individual pieces of that puzzle are released beforehand throughout the quarter and in the weeks leading up to the main release.
Ah, okay.
These are the partials.
So they're looking at pieces like retail sales figures, building approvals, trade numbers, employment data, all these different statistics that come out earlier.
Exactly. The document mentions the key partials for components like inventories held by businesses, international trade figures, exports and imports,
Hmm.
and data on public spending by governments were still scheduled to be released early in the week following the document's date.
Okay.
NAB economists use all the partial data available up to the moment they write the report. Retail sales, manufacturing data, construction activity, employment figures, and many more to build a model and estimate what the final GDP puzzle is likely to look like. The release of those final few partials mentioned in the report would then allow them to further firm up the estimate ahead of the release, getting even closer to the final expected number.
Okay, that makes total sense. So this preview isn't just a shot in the dark. It's a highly informed, data-driven estimate based on looking at most, but maybe not quite all, of the key economic puzzle pieces that are already out there. It's their best guess based on the evidence at hand.
Precisely. It's a sophisticated economic forecast built from the ground up using the available earlier data points.
Now, moving beyond just the headline number, the introduction and even the title of the source report itself strongly highlight a key dynamic at play. The idea that private sector strength is helping offset slowing household consumption.
Yeah, that's the core theme.
This sounds like the core story of Q1, according to NAB. Let's really dive into that. What exactly does the source mean when it says the private sector made a solid contribution to growth?
Okay, so the report clearly states, based on partial data to date, the private sector looks to have made a solid contribution to growth in the quarter.
Right.
In economic terms, the private sector essentially boils down to two main components. Households, which drive consumption through their spending.
Us, basically.
Yeah, exactly. And businesses, which drive investment and their own operational activity. So collectively, the activity generated by consumers and companies together appears to have been a significant positive force, contributing to that forecast 0.5% GDP growth number.
But as that headline theme suggests, within that private sector picture, there's a bit of a divergence or at least a nuanced story. On the household side, it sounds like things weren't exactly booming.
Yes.
What's happening specifically with household consumption according to this report?
The source is quite specific here. It indicates that partial indicators point to some loss in momentum for household consumption growth in Q1.
Loss of momentum.
Okay. This doesn't necessarily mean that consumers stopped spending or spent less in absolute terms compared to the previous quarter. Instead, it means the rate at which their spending was increasing appears to have slowed down.
Aha.
The growth is still positive, but it's decelerating. Think of a car still moving forward, but pressing the brake pedals slightly.
Ah, okay. Loss of momentum. That's a key distinction. Still growing, but at a slower pace. Why might that be happening? Does the report give any hints?
The report doesn't delve deeply into the causes in this specific preview, but it does flag some factors that complicate how we might interpret the headline consumption number in the official data.
Oh, like what?
For example, it mentions that the unwind of subsidies in the quarter may boost the headline number.
Unwind of subsidies? What kind of subsidies are we talking about? And how on earth could the ending of a subsidy actually boost the consumption number? That seems counterintuitive.
Yeah, it does sound odd, doesn't it? It likely refers to temporary cost of living measures, such as, say, energy bill relief, or other direct payments that might have been provided by governments in previous periods.
Right, like those power bill credits.
Exactly. When these subsidies are removed or reduced, the price that consumers pay out of their own pocket for those goods or services increases.
Okay.
For instance, if an electricity bill was previously subsidized, the cost to the household was lower. When the subsidy is removed, the household's bill goes up.
Right.
Even if the household uses the exact same amount of electricity, their expenditure on electricity recorded in the economic data goes up because they are now paying the full, unsubsidized price.
Ah, I see.
This increase in the dollar value of spending, driven by price changes rather than increased volume of consumption, can artificially inflate the headline figure for consumption, making it look stronger than the underlying real activity.
The actual stuff people bought.
Yeah, the actual amount of goods and services consumed might suggest.
Right, you're spending more money, but you're not necessarily consuming more stuff. It makes the number look bigger, but it doesn't mean people are actually buying more groceries or going out to dinner more often.
Exactly.
That's a really important nuance. The headline number might look okay, but the underlying trend of actual activity could be weaker due to that price effect from subsidy removal.
Precisely. It's a potential distortion to keep in mind when the official numbers come out. The report also mentions another potential source of volatility in the data. Ex-cyclone Alfred may also drive some volatility in the QLD numbers.
Ex-Cyclone Alfred. So a natural disaster impacting the data.
Yes. Significant weather events like cyclones can cause major disruptions to economic activity in affected regions, in this case, Queensland.
Makes sense.
Businesses might close temporarily, supply chains are interrupted, and consumer spending patterns are disrupted. Initially, you might see a dip in some areas, followed by a surge in spending related to cleanup and rebuilding efforts.
Yeah, insurance claims, repairs.
Exactly. These swings can introduce volatility into the regional data, which then feeds into the overall national figures, potentially making them harder to interpret as reflecting underlying trends. It's an external shock impacting the smooth flow of economic activity.
So pulling the household consumption picture together for the listener, the underlying momentum of consumer spending growth appears to be slowing, which aligns with that overall narrative of caution. But we need to be wary of the official headline number potentially being boosted by factors like the removal of subsidies, making it look slightly stronger than the real picture.
Right, that price effect.
And also regional volatility from events like cyclones impacting specific areas. It's a complex picture beneath the surface.
That's a very accurate distillation of the points made in the report about household consumption. It's not a simple story of spending is falling. It's about slowing growth momentum and potential data distortions.
Okay, so that's the household side slowing momentum. But the headline theme also mentioned private sector strength offsetting this. So other parts of the private sector must be picking up the slack.
Yeah, they must be.
The source points specifically to investment?
Absolutely. The document provides a more positive picture for investment, stating that the business and dwelling investment partials point to a positive contribution to growth in the quarter.
Okay, investment. What kind of investment are we talking about here? Break down those components for us.
Sure. There are two main categories highlighted here. Dwelling investment, which refers to residential construction, building new houses, apartments, or undertaking significant renovations.
Building homes.
Pretty much. The table included with the source shows a forecast for dwelling investment to have grown quite strongly in Q1, projecting 3.3% quarter-on-quarter growth.
Wow, 3.3%.
Yeah, and this component alone is expected to add a positive 0.1 percentage points to the overall 0.5% GDP growth forecast. So the housing construction sector seems to have been a positive force.
Right, residential building adding to growth. What about business investment? What does that cover?
Underlying business investment captures what businesses are spending on to operate and expand their capacity for the future. This includes things like buying new machinery and equipment, technology, vehicles.
Investing in their future.
Exactly.
Yeah.
And also non-dwelling construction building commercial properties like offices, factories, warehouses, and infrastructure related to their operations.
Okay.
The sources table indicates that this broader category of business investment is also expected to make a positive contribution to Q1 GDP growth, contributing 0.1 percentage points.
Now, this is the part that can look a bit confusing at first glance when you look at the numbers in the table, isn't it?
Uh-huh.
The source text says it points to a positive contribution. But the table shows the QQ growth rate for underlying business investment is actually forecast to be negative, specifically minus 1.6%.
Right, minus 1.6.
And the document even notes this positive contribution comes despite a small fall in machinery and equipment spending, which is a significant part of business investment. How can something that fell quarter on quarter still make a positive contribution to overall GDP growth? That seems counterintuitive.
That's a fantastic point, and it gets into the technicalities of GDP accounting, but the core idea is understandable. GDP growth is calculated based on the change in the dollar value of goods and services produced or spent in the economy, weighted by their share of the economy in the previous period.
Okay.
When the report says positive contribution, it means that this category of spending compared to the previous quarter added a certain number of percentage points to the total GDP growth calculation.
Right.
Even if the value of investment fell slightly, minus 1.6% QQ, it's still a huge component of the economy. Its positive contribution of 0.1 percentage points despite that fall likely means one of a few things. Either the fall was much less severe than maybe some expected, or other parts within that broad underlying business investment category, like non-dwelling construction, which might have were strong enough to partly offset the fall in machinery and equipment relative to its large size.
Right, offsetting effects.
Or perhaps year-on-year dynamics or inventory changes related to investment are factoring into the economist's model in a way that results in this net positive contribution to the overall aggregate GDP figure for the quarter. The key takeaway, as the report states and the table confirms via the zero point 0.1 PBT figure, is that the economists see investment as being a net positive force in the Q1 growth calculation, despite that specific fall in machinery and equipment spending.
So it's still helping push things forward overall.
Exactly. It's contributing to the overall forward momentum, even if one engine is sputtering slightly.
Okay, that clarifies it. The net effect of business and dwelling investment combined is seen as a positive driver for the economy in Q1, adding to growth, even if one specific element within it had a minor dip. So, using that earlier analogy, while consumers might be tapping the brakes a bit, businesses are continuing to spend on their future operations, and builders are busy putting up new homes and commercial properties. That investment activity is helping to fill some of the gap left by the slowing pace of household spending, propping up that forecast 0.5% growth number.
That's exactly the dynamic this section of the report is highlighting. Investment is stepping up where consumption is easing its momentum.
Right. GDP isn't solely driven by the private sector, though. Governments, through public spending, and Australia's trade relationships with the rest of the world also play significant roles.
Absolutely.
What does this source tell us about those contributions in Q1?
Okay, let's look at the public sector first, government spending. The report notes their expectation for a further increase in both public sector consumption, including health and education, and public investment in coming quarters.
And specifically for Q1, what did they pencil in?
For the first quarter, the table indicates that underlying public final demand is expected to have made a positive contribution to overall GDP growth.
How much?
The forecast is for 1.0% growth in this component, quarter on quarter, which translates to a quite significant contribution of 0.3 percentage points to the total 0.5% GDP forecast.
Wow, 0.3 out of 0.5.
Yeah, it's big. This category includes two main parts: public consumption, which is the government's day-to-day spending on providing services like healthcare, education, defense, and public administration.
Keeping the lights on.
Pretty much, yeah. And public investment, which is government spending on infrastructure projects, building roads, railways, hospitals, schools, etc.
A 0.3 percentage point contribution out of 0.5% total growth is substantial. Government spending was clearly a major support in Q1, according to this preview.
Definitely a key driver.
Does the report expect that level of support to continue going forward?
The source suggests that while public sector spending is expected to remain a support, meaning it will continue to add to growth, the pace of that contribution is likely to ease from here.
Ah, okay.
The reason given is that infrastructure pipelines continue to level off. This implies that the significant boost from major infrastructure projects might be peaking or slowing down, leading to a less dynamic contribution from public investment in the immediate future compared to recent quarters.
Okay, so a strong boost from government spending in Q1, but perhaps less of a propellant going forward. What about inventories and net exports, the trade picture?
Right. These are often considered more volatile components of GDP, but they are included in the previous forecast. The table shows that stocks, representing changes in business inventories,
Goods sitting on shelves.
goods produced but not yet sold, yeah. They are expected to contribute positively in Q1, adding 0.1 percentage points to growth. An increase in inventories adds to GDP in the quarter they are produced.
Okay, 0.1 from inventories. And what about net exports, the value of Australia's exports minus its imports?
For Q1, the forecast for net exports is a negative contribution. The table lists it as negative 0.2 percentage points.
Minus 0.2, so a drag on growth.
Yeah.
A negative contribution means that, on balance, trade detracted from growth. This would happen if the value of imports grew faster than exports, or if exports fell while imports grew or remained steady.
Correct. According to this preview, the external trade sector was a drag on overall domestic growth in the first quarter.
Okay, let's quickly put the pieces together that build up that 0.5% forecast. You've got household spending growth slowing, but business and dwelling investment making positive contributions,
Yep, point one each.
supported by a significant positive contribution from public spending in Q1,
The big point three.
with inventories adding a small boost,
Another point one.
all slightly offset by a negative contribution from net exports.
Minus point two. Add it all up, you get the point five.
Those are the engine rooms driving the economy, according to this report's Q1 forecast.
That component breakdown is fundamental to understanding where the overall growth, or lack thereof, is coming from in any given quarter. It's the nitty-gritty.
Absolutely. Now, while the 0.5% GDP growth number is the one that hits the headlines and gets reported widely, the actual release of the national accounts data, the full report, is so much richer.
Oh, way richer.
It contains a treasure trove of deeper indicators that give us a far more nuanced picture of the economy's health beyond just that single growth figure. What other crucial insights does this source say we absolutely must look for when the full data comes out?
Right. This is where we really get into the deep dive elements that matter for understanding the underlying dynamics, not just the top-line number. The source notes that the national accounts provide the most comprehensive view on several absolutely key areas.
Such as?
The first is household income and savings dynamics.
Okay, income and savings. Why is getting a clear picture on how households are earning and saving so critical to understanding the economy right now?
The document emphasizes this point, stating that a clearer picture on savings trends and real income drivers will provide additional context. They connect this directly to the future of consumer spending, highlighting that improving real income remaining key to sustaining the recovery in consumption and activity more broadly.
Let's really make sure we understand real income. That's your income adjusted for inflation, right? It's
Yeah.
not just how many dollars you earn, but what those dollars can actually buy after accounting for rising prices.
Precisely. Spot on. If your wages go up by 3%, but prices go up by 4%, your nominal income is higher, but your real income has actually fallen. You are effectively poorer because you can buy less with the same amount of work.
Right. Your purchasing power shrinks.
Exactly.
Yeah.
For households to genuinely increase their spending sustainably, their purchasing power, their real income needs to improve. The report is saying this is the fundamental driver needed for the expected recovery in consumption to actually stick and broaden out across the economy.
Makes sense.
If real incomes aren't truly improving, any increase in spending would have to come from drawing down savings or increasing debt, which isn't a sustainable path for long-term recovery.
And on the savings point, the source adds a note of caution.
It does. It highlights that the savings rate remains low relative to its pre-pandemic level.
Lower than before COVID.
Yeah. This means, on average, households are tucking away a smaller percentage of their income compared to what they were doing before the pandemic hit, coupled with the fact that consumer confidence has generally been weak.
Yeah, confidence hasn't been great.
The source suggests that this low savings rate and weak sentiment may see some restraint in consumption going forward. If people have less buffer built up in savings and feel uncertain about their financial future or the economy, they're likely to be more cautious about splashing cash, even if their real pay packets are starting to look a bit better.
Okay, so the national accounts will give us the crucial data on whether real incomes are definitely improving and exactly what's happening with that household savings rate. Are people dipping further into savings, or is it stabilizing?
Exactly.
This detail is vital context for interpreting the consumption figures we discussed earlier. What else should we be looking for in the national accounts?
Another absolutely vital indicator that this report flags is productivity growth.
Productivity. It's one of those terms people hear a lot, but what does it really mean in simple terms, and why is it so important for the economy?
Yeah, it can sound a bit jargony. In its simplest form, productivity is about efficiency, getting more output from the same amount of input.
Doing more with less or the same?
Exactly. For example, if a worker can produce more widgets in an hour today than they could last year using the same tools and resources, productivity is increased. Or if the economy as a whole can generate more value, higher GDP, with the same amount of work hours, that's a gain in productivity.
Okay.
It's fundamentally about how efficiently we're using our labor and capital to produce goods and services. Why is it important? Because sustained productivity growth is the engine of rising living standards.
Right.
It allows businesses to pay higher wages without necessarily having to increase prices rapidly, as the increased wage cost is offset by the fact that workers are producing more. It's key to non-inflationary growth and boosting the economy's overall capacity.
So it's how we get wealthier as a nation without just causing more inflation. What does this source anticipate for productivity in Q1 specifically?
The report offers a cautiously optimistic note for the quarter itself, suggesting that productivity looks to have increased slightly in the quarter, with output growth likely outpacing the growth in hours worked.
Okay, so output grew faster than hours worked.
That's the implication.
Yeah.
It means that the increase in the total value of goods and services produced, output growth, in Q1 was likely faster than the increase in the total number of hours people worked, implying workers were, on average, a little more efficient.
That sounds like good news.
It is, but the report immediately adds a crucial piece of context that tempers that optimism.
Aha, there's always a but.
Yeah. It states, though this trend will need to be sustained following weak outcomes over recent years. Australia has faced challenges with weak productivity growth for quite some time.
Right, it's been a problem.
So one quarter of slight improvement is a positive sign. But the real test is whether this can become a sustained trend. A single good quarter doesn't solve the longer-term challenge of boosting the economy's efficiency. The national accounts will provide the definitive number on whether that slight increase actually occurred.
Okay, so productivity is a key number to scrutinize for signs of a potential turnaround in a worrying longer-term trend. What other detailed measures does the report say are important in the national accounts?
The report notes that the national accounts provide a broader set of cost-price measures. This gives economists and the RBA a more granular look at inflationary pressures across different sectors of the economy, which goes beyond just the standard consumer price index most people follow.
More detail on prices.
Yeah, and very closely linked to both inflation and the labor market is another key measure.
Yeah.
Nominal unit labor costs growth.
Unit labor costs, you mentioned this before, but let's really unpack it. What exactly are nominal unit labor costs and why are they so important right now?
Okay, think about the cost of labor that goes into producing just one unit of something, say, one loaf of bread or one car. Nominal unit labor costs measure the total labor costs, wages, superannuation, etc., divided by the amount of output produced.
Labor cost per thing produced?
Basically, yeah. So it's effectively your labor cost per unit of output without adjusting for inflation just yet. It tells you how much the labor cost component of producing goods and services is changing.
Right.
If nominal wages are rising quickly, but productivity isn't keeping pace, meaning workers aren't producing significantly more, then the unit labor cost goes up sharply.
Wages up, efficiency not up, equals higher cost per unit.
Exactly. Businesses then face higher labor costs for every unit they produce, which can put significant pressure on them to raise the prices they charge customers to maintain their profit margins.
And what is the situation with unit labor costs according to this preview?
The source explicitly states that unit labor cost growth remains elevated.
Elevated. Still high.
That's the message. It means that the labor costs associated with producing a single unit of output is still increasing at a rapid pace.
Why is this specific measure, elevated unit labor costs, such a critical focus area, particularly for the RBA right now?
This is perhaps one of the most important takeaways from this section for understanding the RBA's current dilemma. The document spells it out. Elevated unit labor costs will continue to form an important input into the RBA's assessment of tightness in the labor market and sustainability of the unemployment rate in the low 4% range.
Okay, unpack that link for us.
The RBA is watching this like a hawk. A low unemployment rate, like the low 4% range Australia has seen, suggests the labor market is tight to left. Businesses might find it harder to find and keep staff, which puts upward pressure on wages.
Supply and demand for workers.
Right. When wages rise rapidly, without a corresponding increase in productivity, unit labor costs jump. This signals to the RBA that there are persistent cost pressures coming from the labor market that could make it harder to bring inflation sustainably back down to their 2–3% target range and keep it there.
So it threatens the inflation target.
Potentially, yes. It raises questions about whether the current low unemployment rate can be sustained without causing too much inflationary heat via wage pressures that aren't offset by productivity gains.
Wow, that really connects the dots. So beyond the headline GDP number, the national accounts provide this crucial underlying data on how households are genuinely faring after inflation, real income. Whether the economy is getting more efficient, productivity.
Crucial.
And critically, whether wage pressures are building faster than efficiency gains, potentially feeding into inflation and complicating the RBA's job unit labor costs.
Exactly.
These are the numbers the RBA will really be poring over.
Exactly. These are the structural and cost dynamics that tell a deeper story about the economy's health and its capacity to grow without generating excessive inflation.
Here's where it gets really interesting, and perhaps the most anticipated part for many listeners who follow central bank policy. How does this entire Q1 GDP picture, as forecasted in this NAB preview, the 0.5% growth, the specific contributions, the insights into income, savings, investment, and unit labor costs, how does all of that factor into the Reserve Bank of Australia's thinking right now?
Well, as we noted right at the start, the headline forecast of 1.5% QQ growth is described as broadly in line with their May SOMP forecasts.
Okay, so no surprise there.
Right. So from the RBA's perspective, the aggregate pace of economic activity in Q1 looks like it unfolded roughly as they had anticipated. That consistency is usually reassuring for a central bank. It means their models weren't wildly off for that specific quarter.
Okay, so the growth number itself isn't the shock, but the source highlights a really significant shift in the RBA's overall focus right now.
This is the absolute critical point for monetary policy expectations, according to this report. It states unequivocally, however, with inflation back within the target range and global growth risks tilted to the downside, the focus from here will become more balanced between the inflation and labor market components of the RBA's mandate.
Right, more balanced. Let's dissect that.
Yeah.
The RBA has a dual mandate, right? Price stability, getting and keeping inflation between 2–3% and aiming for full employment.
Correct.
This report is saying that because they've largely achieved the inflation target, they can now give equal weight to both goals again.
Precisely. For a significant period when inflation was stubbornly high and well above target, the RBA's overriding priority was to bring it down, even if it meant potentially cooling the labor market.
Inflation was enemy number one.
Absolutely. Their focus was heavily skewed towards price stability. But now, according to this assessment, with recent inflation data bringing the rate back into or close to that 2–3% target range, and with increasing concerns about the global economic outlook, those global growth risks tilted to the downside.
Yeah.
The RBA's focus can become more balanced. They can now afford to pay closer attention to conditions in the job market and broader economic growth trends alongside their inflation watch. This preview comes at a time when the RBA is pivoting its attention.
That's a fundamental shift in their perspective. So given the shift and the Q1 data picture, what specific parts of the economy and these national accounts figures will the RBA be watching most intently in the coming period, according to the source?
The report is quite clear on the key indicators the RBA will be scrutinizing. First, they'll be watching the durability of the pickup in consumption.
Durability. So will it last?
Exactly. While Q1 showed slowing momentum, the forecast is for consumption to recover. The RBA needs to see if that recovery is robust and sustained. Why durability? Because a weak or faltering consumption recovery would signal ongoing household stress and broader economic fragility,
Warning signs.
which could impact their growth forecasts and potentially necessitate a different policy response.
Makes sense. If consumers can't sustain increased spending, the recovery narrative is in trouble. What else is on the RBA's watch list?
They'll also be closely monitoring trends in private business and dwelling investment, which will need to sustain the relatively healthy outcomes expected in the quarter.
Keeping an eye on investment.
Yeah, we saw these contributed positively in Q1 in this preview. The RBA will need to see this momentum continue and strengthen for overall economic growth to return to what they consider the economy's trend or sustainable potential growth rate, as outlined in their own projections.
Right.
Sustained business and dwelling investment is crucial for expanding the economy's productive capacity and supporting job creation going forward.
And bringing it back to those deeper national accounts indicators we identified earlier, income, savings, productivity, and unit labor costs. How do they feed into the RBA's assessment now that their focus is more balanced?
Absolutely critical. The report reiterates that the unit labor costs and productivity data will be essential inputs into the RBA's labor market assessment and their inflation outlook. Elevated unit labor costs raise a red flag about potential wage-driven inflationary pressures, particularly in a tight job market with unemployment in the low 4% range.
That low unemployment, high wage pressure link.
If productivity doesn't improve significantly, those wage pressures are more likely to translate into higher prices. The RBA needs to gauge whether the current level of unemployment is sustainable without sparking a wage price spiral. These figures directly inform their view on how tight the labor market truly is in a way that matters for their inflation target.
So while the Q1 GDP number aligning with their forecast is reassuring in one sense, The RBA's future policy decisions, whether to potentially consider easing monetary policy or hold rates steady for longer, will largely hinge on the detailed picture revealed by the full national
The
accounts.
underlying details, yeah.
Is the consumption recovery durable? Are investment trends holding up? And crucially, are unit labor costs and productivity trends compatible with bringing inflation sustainably back to target while maintaining low unemployment?
hmm
The details matter immensely.
That's precisely the interpretation of this data's significance for the RBA that comes through in this specific source. It confirms the Q1 forecast was on track, but pivots the focus firmly onto the underlying drivers and cost pressures that will shape the economy's path, and thus the RBA's policy choices from here.
Okay, so that provides a really comprehensive picture of Q1 2025 based on this specific preview and what it means for the RBA. But this document doesn't stop there. It also looks ahead.
Right, it has an outlook section.
What does it tell us about ME's expectations for the Australian economy for the rest of 2025 and into 2026?
The source provides a clear, forward-looking view, outlining their base case expectations and, importantly, identifying the major risks to that outlook. On the consumption front, despite the Q1 slowing momentum, they do expect a recovery to take hold.
Okay, expecting a pickup.
Yeah, stating we expect consumption growth to continue to recover, supported too by ongoing real incomes growth.
So they anticipate the improving real income story we discussed, people's purchasing power genuinely increasing after inflation, will indeed eventually translate into households feeling confident enough to loosen the purse strings and increase their spending at a faster pace.
That's the core expectation for consumption recovery. However, they are quick to list factors that could act as significant headwinds, potentially restraining the pace or extent of that recovery.
What are the headwinds?
They reiterate that the savings rate remains low relative to its pre-pandemic level, and weak consumer confidence may see some restraint.
Right. Low savings, weak confidence.
This suggests that even with improving real incomes, the lack of a savings buffer and general consumer caution could limit how much extra money people are willing or able to spend.
And there's another structural factor they mention related to population growth.
Yes, they point out that population growth is slowing and will not be as significant a support as recent years.
Ah, population.
Australia has experienced very strong population growth recently, which has been a major contributor to overall aggregate demand and consumption simply because there are more people buying things.
More people, more spending, generally.
Exactly. As that growth rate moderates, it will naturally exert some downward pressure on the total consumption figure, even if spending per person were to increase.
What about the investment picture looking ahead? Is that expected to continue supporting growth?
The source is clear that for the economy to move back towards its potential speed limit for growth, what economists call the trend growth rate, continued investment, is non-negotiable.
Need that investment.
Yeah, they state that an improvement in business investment growth and sustained growth in dwelling investment will be required for overall growth to return to trend. This reinforces that investment is seen as a crucial engine for future expansion.
And public spending, which was a strong contributor in Q1.
As we touched on earlier, while public sector spending is also expected to remain a support, the report anticipates that growth is likely to ease from here as infrastructure pipelines continue to level off.
Easing off.
So it will still be adding to GDP, but perhaps not with the same vigor as seen recently.
Putting all these expectations together for the different parts of the economy, consumption, investment, public spending, trade, inventories, what's the overall growth forecast from DB for the next couple of years based on this outlook?
The source summarizes their overall projection. Overall, we see growth over 2025 remaining below trend despite the ongoing recovery before rising to around 2.25% over 2026.
Below trend in 2025. Okay, so they're forecasting a gradual recovery but still operating below the economy speed limit throughout 2025, with growth only picking up closer to 2.25% in 2026.
That's the trajectory they map out based on their analysis of these various components, sort of a slow grind back.
And finally, every forecast comes with risks. What does this source identify as the major risks that could potentially derail this expected outlook, according to NAB Economics?
They pinpoint one primary area of concern, stating, "We see the largest risk to growth this year coming from a weaker global backdrop."
The rest of the world, basically.
Yeah, international factors.
A weaker global economy. How would that weakness overseas specifically impact Australia, according to this report?
The document explicitly links the global risk to domestic outcomes. It warns of The risk that heightened global uncertainty leads to weaker business investment and employment outcomes and weighs on consumers despite the improving real income story.
That chain reaction makes sense. If things look shaky internationally, businesses globally and locally might become more cautious.
They pull back.
This could lead Australian businesses to pull back on their investment plans, like buying new machinery or building new facilities, and potentially slow down hiring or even reduce employment.
Job jitters.
If people see job uncertainty increasing, even if their wages are holding up in real terms, that hits confidence. And if confidence falls, they're more likely to rein in their spending, reinforcing that cautious consumer behavior we saw hints of in Q1.
Yeah, it feeds back on itself.
It could undermine the expected recovery in consumption and investment.
That's the specific mechanism through which the report sees a weaker global environment posing the most significant threat to the domestic growth outlook they've outlined. It's seen as the major potential disruptor to their base case of gradual recovery.
We've now taken a really comprehensive deep dive into this specific preview from NAB Economics looking at Australia's Q1 2025 GDP. We've gone beyond the headline forecast numbers of 3.5% QQ and 1.7% Y
Yeah, the headline numbers.
to really unpack what's driving them, highlighting that fascinating dynamic within the private sector, where business and dwelling investment strength appears to be helping compensate for the observed slowing momentum in household consumption.
That balancing act.
We peeled back the layers to examine the crucial underlying indicators within the national accounts, the insights into household income and savings trends, the cautious but potentially improving picture on productivity, and those elevated unit labor costs that are so important for the inflation story.
All those key details.
We've spent time understanding what the RBA might take away from this data, particularly now that their policy focus is becoming more balanced between inflation and the labor
It's
market.
that shifting focus.
And we've peered into the future, looking at the expected path of recovery, the headwinds holding consumption back, the need for sustained investment, and critically, the major risks posed by the global economic picture.
This analysis from NAB Economics paints a detailed picture of an Australian economy in a delicate phase. It's navigating a complex interplay of forces. Cautious households still finding their footing.
Yeah, watching their pennies.
Segments of the private sector, like investment, showing resilience, public spending, providing significant support in the recent past, but potentially easing. And all of this under the constant assessment of the RBA as it seeks to achieve its goals.
They're twin goals.
In a domestic economy facing structural challenges like productivity and unit labor costs, and potential vulnerability to the international environment.
What stands out most to you from the specific snapshot of the Australian economy? How do these different pieces, your own spending behavior, the decisions businesses are making about investing, the government's budget choices, and even economic conditions happening on the other side of the world, how do they all seem to fit together in your mind after exploring the insights from this source?
It underscores that while the inflation picture has improved, the path to sustain healthy economic growth isn't guaranteed. There are significant domestic dynamics, like household confidence and productivity trends, but also major external factors that could easily shift the landscape. It's still pretty uncertain.
And based only on the insights presented in the source, if improving real income is highlighted as absolutely key to sustaining the consumption recovery we hope for, but the report then identifies the largest risk to growth this year as a weaker global picture that could weigh on investment and jobs, leading back to consumer caution.
Yeah, that connection.
Doesn't that suggest that right now, the health of the global economy is perhaps the single most critical swing factor determining whether Australia achieves that hoped-for domestic recovery this year? It really puts the focus outside our borders.
That's a really sharp point. The external risk seems paramount, according to this analysis, if the world economy sneezes.
Australia might catch a cold. It's definitely something to keep thinking about as we await the official data releases and listen closely to future commentary from the Reserve Bank.